Welcome to the Finance Village podcast, where we navigate the dynamic relationship between financial professionals, their industry, and the clients they serve in an ever-changing landscape. Let's begin. Hi, everyone. Welcome to another episode of Finance Village. I'm your host, Sheldon Bro, and I've got my wonderful co-host, Sean Adeyemi, financial planner extraordinaire. And today we're going to be talking about how car payments undermine wealth building. So let's start, Sean, by talking about maybe some of the things that people want to have in place before they get too cocky or too bold about a big car payment.
Well, I mean, when I think about it, just car payments, before you start thinking about car payments, and sometimes people don't even think about it, they already have it. But if you're to back up and say, what are the things I need to have? I would say emergency fund, right? Have an emergency fund that can help supplement or fill in gaps when things happen, because life does happen. It happens to every single one of us. I don't care how lucky you think you are, you're going to have a bad time where you need extra funds to do one thing or the other. I think emergency fund is a big piece of...
Or a car emergency.
Car emergency,
how many
there you
people
go.
actually have $2,000 set aside, even above and beyond an emergency savings, but even within your emergency savings for things that come up? There's been once every 6 months I've had to spend $1,500 on our vehicle, and it's been a great vehicle. We bought it secondhand cash for $4,100, 2012 Subaru Forester. We could afford to take on a car payment, and I would suggest that, you know, people have become, it's become a staple to accept always having a car payment.
It's like
and
a
I'll
pet.
give you an example. Yeah, like people always think that they should have one, and then once they get rid of one, it's like time to buy a new car. And now reinvest that money. If people could see a chart every time they went to buy a car of taking that $500, I think it's a $600 a month average in North America that people are paying for cars. If they'd be able to see in a calculator in a chart to see the $500 or $600 a month going down in their net worth versus if they invested that, it's going to be a pretty huge difference, and you're going to see a stark contrast in the net worth going up or going down. So for a new car in Canada, the average car payment is around $1,000.
That's insane.
Used is around $620, and a lot of people are now going beyond the 5 years and going out
7 years,
to six and 7 years, and longer amortizations are always feel desirable because people are always focused on cash flow. Even more focused on cash flow than they are on interest rate, because as long as they can make the small payment, they'll make it over 1,000 years.
But the problem with that is that, yes, you get a lower car payment, but by the time you're 7 years in, you're still paying for a car that's not even worth a quarter of what you paid for it.
I will only replace my car if there's a major fuel efficiency issue, because there's long math there. But the number one reason I would only consider replacing my car is family safety. That's the
Correct.
only thing that would give me, and that's how the mechanics always get us. And just quickly to speak to your negative equity, many consumers, and it's very, very prevalent, find themselves in underwater loans where they owe more on their car than the current market value, and they don't even realize it half the time. And this all happens because of the rapid depreciation of new cars. About 44% of all trade-in towards new cars involved have negative equity, with the average amount of negative equity being 5,000%, meaning you owe more. So quickly, let's just touch on, Sean, maybe not just why you wouldn't just want to go buy a new car, but how can somebody properly and intelligently assess? Because that's something that's not often talked about. Is there calculators online? Is there a process you can go through with your advisor? Is there something you can sit down and do with your spouse on your own? How can somebody better assess how to buy what they're actually able to afford? And then maybe we'll quickly touch on if somebody's already in the position where they've made that bad decision and they want to be responsible now, what can they do to correct that?
I think the first thing I would ask is, do you want a car or do you need a car? If the question is yes, you need a new car, the question then becomes, what's the market like for the type of car that suits your family? I think most times I've heard people make excuses that, well, you know, I prefer a new car because it doesn't have issues. I'm not going to have all this trouble. And so they go right to the 2024, 2025, whatever car model they like. And I say that's actually not a good decision to make, because a used car is most times equally as reliable as a brand new car. And the difference in prices is stark. You could get a brand new car for like 30,000, and let's say hypothetically, and you can get a decent used car for like 22,000,
Well,
19,000.
that's something I'm always wondering about, because half the time, you think about used cars, you think about the sleazy used car salesman. You've heard a lot of horror stories there, but then you hear with new cars that they haven't worked the kinks out, and they're kind of, you're going to run into those initial troubles and this and that.
I think one of the things people rely on in new cars, well, it's a brand new car. I'm still going to get my 1,000 kilometer or 1,000 mile warranty,
I've got my warranty,
right?
but they forget that that warranty is coming at a cost, as though it's some type of free warranty. There's
Freebie.
not anything built into it.
Exactly. So typically, when I'm buying a used car, I go to a reputable dealer that I know I trust, that they sell good used cars. Or at the very least, I take my mechanic to wherever I'm buying, and I have them check that car top to bottom and show me everything that's wrong with that car.
Your mechanic, not theirs.
And then once you decide, okay, I'm going to get a used car because it is X percent or X dollars cheaper, the question then becomes, how do I buy this car? If you don't have a savings already, if you don't have an emergency fund already, that's where the car payment question typically comes in.
I want to challenge on the want and need thing very quickly, because there's a wonderful philosophy. Rumi says, be suspicious of what you want. And I'll twist that slightly to say, be suspicious of what you think you need, because how many times I've convinced myself that I actually need something when I don't. Talk to a third party, and if you don't have the confidence, or you don't want to reach out to a financial professional, you don't have one, talk to somebody, a brother or sister. Don't talk to somebody that's going to feed what you want to hear. Talk to somebody that's going to challenge you a bit and say, I'm thinking about getting a new car, blah, 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 blah. And give them the reasons, because a lot of the times when you think you need it, you don't. And there's a lot of stuff that comes along with it. Those creditor insurances that they try to add on.
That's
Talk
right.
to us about the creditor insurance for a moment. Oh, it's almost a blanket statement that you should never get the insurances that the bank sells you on lending, or that the car sales company sells you on lending, because it's like buying a sandwich in the airport. If you buy a sandwich in the airport, it's a lot more expensive.
I say don't waste your time getting the creditor insurance, because it doesn't really do anything. It doesn't protect you. It only protects the car, the financing company that is providing. They get paid to offer you that creditor insurance, but it doesn't really protect you from anything.
It offers you some protections as the consumer, but they're terrible. I've read the one for credit cards, and I'm gonna accentuate this and kind of carry it over to any creditor insurances in the way that it's built more to benefit the institution than it is to benefit the consumer. Where if you buy it independently through an actual insurance advisor, if you want to get insurances, they can give you the appropriate amount. But the way that they'll typically work, and one of the ones that I hate the most is the creditor insurance on the credit cards, is if you become unable to make your credit card payment and you have one of the creditor insurances like the critical illness or the disability, it will actually make the minimum payment for you on the credit card. And not all of them, but this is pretty broad in general.
Right, just the interest
As far as
payments.
quality, they'll make the minimum payment for 2 years. So you've paid a higher premium. You're getting the minimum payment, which is what the credit card companies, the company that has the credit card that finances for you, they want you to make the minimum payment forever, because that's maximum profitability for them. So at the end of the 2 years, you almost owe the same amount.
You owe the
because you
same
barely
amount of
got
money, maybe even a little
payment
more.
difference. So that extra cost, most people think that getting creditor insurance on their car loans or other financing is mandatory. It is sold as an assumed sale. You have to always ask, is this optional? And most of the times, if it's insurance that's optional that you're buying from the person that's giving you the lending and the financing, it's too expensive. It's not a good product. Talk to an insurance advisor. And you're further depleting your ability to afford that car by taking on those careless insurances.
Let me play devil's advocate for the creditor insurance provider. Well, you now have, rather than missing payments on your car and having your car repossessed, now you have the minimum payments covered at the very least, so you can still drive your car while you recover, and you don't also
Well, you
then
should
get
just have
credit.
emergency savings. You could put that garbage. You could put that monthly payment of the credit insurance into monthly savings. Credit insurance is the devil. I'm going to go ahead and say it. It's the devil.
That's typically the argument. And I said that for a purpose. Is it's going to protect your credit. It's going to protect you from losing your car in the case of sickness or illness. But guess what? You're paying a premium.
So let's quickly touch on, Sean, length of payment, because there could be a lot of different opinions on that. I find myself almost kind of bipolar about it, but typically, and it depends on the character of the client, but as a general theme, I like to minimize cash flow payments. So while I did mention at the beginning of the podcast that a lot of people are willing to take things out over 100 years, and I think there needs to be some discretion there, I do like the idea of when you do take out financing for anything, if you have the character to do so, if you're a total mess, then you need to have a good conversation with an advisor, pick that right payment, and have the discipline. But I'm going to suggest that generally I like to have people put these things out over a little bit longer term, so you're minimizing the monthly payment, optimizing the cash flow every month, so you're not stuck with that payment that you can't necessarily afford if you don't have the emergency savings saved yet, and put the extra lump sums on as you can. Put the extras on. I do want to put the extras on a lot. I want to pay it off in the shortest amount of time, but the initial amortization, I like to have people think about setting it over the longer period to have that minimum monthly obligation, because there's too many crazy things going on in the world, too much fluctuate. If you don't have emergency savings, what's your opinion on it?
So let me ask you this: Would you rather like a quick death or a slow death? Because that's what you
Quick death.
Exactly. Right? Because if this car payment, if we're both saying that car payments are a wealth killer, then
But that's
why
if you're
would
guaranteeing me death. That's if you're guaranteeing me death. If it's not guaranteeing me death, then I don't want a quick death. I want a slow, maybe chance of not dying.
no, but if car payments are this wealth killer, then extending your car payments over an extended period of time is killing yourself slowly, because
But you're a financial planner. If I'm doing a lower payment and I'm freeing up that $100 for insurance and that $100 to put into savings and the $50 into the RESP, you like that better for the client. You like that better for your wealth
if you
building.
must finance, I will find a way. Let's put some money down, a little bit of the total amount you need to loan. Put some of it down, and the rest of it spread it over 2 years. Get that quick, painful, but at least 2 years. Even if it's $700, if I can squeeze out of your budget,
You're going to have me press to make a big car payment to pay it off in 2 instead of 5 years and not have insurance coverage for those 2 years?
you're still going to have
Because
insurance.
if I don't have savings, I'm
You're still
frantic
gonna
right
have
now. I'm
insurance
chasing
for
my
those 2
insurance
years.
advisor, and I'm saying I want my insurance in place today. Hurry up and get it done, because the anxiety of not having insurance in place without a huge savings, I don't like it. I'm putting all my money
will
into
get you-
businesses right now, investing in myself. I want to have that cash flow. 2 years of a high car
We-
payment, because I can
we
change
will
it
get you
later.
we will get you the smallest insurance we can right now, because we know we can always increase your insurance payment later.
I don't want the smallest one. I want my wife to be falling out if I die.
I would want to maximize your car payment today, because here's two things that I know are going to work for you. One, we maximize your car payment, we pay it off in 2 years. But if you're in a salaried position, we also know that your salary is going to be increasing ever so slightly every year. So we know that in the first 2 years, we take
We don't
this.
know that. We
Well,
hope. We hope your butt is
well, if
working
we
hard enough to
know-
increase
if
your
we
salary.
know that your
You're not
income-
a complacent person sitting letting inflation make you make less every year. I'm going to call my wife and tell her that you would rather her have a $100,000 insurance policy and a paid off car, than a $500,000 policy where she could buy 3 cars and still have lots of money left.
Well, maybe that's where I
maybe
would choose a term 20 or term 10 over term 30. So I may still get you the $500,000 coverage, but rather than choosing a longer term, I may choose a shorter term, because the shorter term is cheaper, and I'll advise you to get a shorter car payment paid off in 2 years, because I know right after that 2 years, if your salary bump goes up, now we have all this extra $1,000 that we've gotten you used to paying every month. Now we're taking that and put it into your savings. And now you're well on your way to building wealth, than killing you slowly and paying $400 every month and barely squeeze them by. And then at the end of the 10-year race, if you and I were to race, you're taking the $300 monthly payment for 7 years. I'm taking the $1,000 payment for 2-3 years. I can almost guarantee you at the end of the 10 years, I'll be way ahead. My clients will be way ahead financially. And that's why we call car payments the wealth killer, because they are wealth killer. But if you must bite the bullet, do a shorter term and forget about it, but at least you know you have a reliable car for the next 10 years, you can pivot, take that car payment and start saving it. That's my point of view. So let's quickly talk about one other topic before you leave. Still on the topic of car payment, leasing versus buying. Now, we're assuming that this client really needs to get a car and they want to buy leasing versus financing, rather. Leasing typically is you'd pay monthly amounts, and you're basically borrowing the car, but the car never belongs to you. One of the benefits to leasing is, for the most part, the dealership will cover the heavy maintenance on it. You still have to pay little things here and there, but for the most part, the car, because you don't own the car, so the car dealership takes care of a lot of the maintenance. So that's one pro many people talk about why it's better to lease a car. On the financing side, however, you own the car, you're simply making the payments monthly on the car. If I were to pick, I would always pick buying versus leasing, because at the end of the day, I think 90% of the time I would pick buying. Now, if I was buying it through my corporation,
I'd like to get an accountant arguing with you on this.
So
some of these self-employed folks,
that's
for the people that can't get past the Day and they always need to have the new car.
And that's where I was going with that. If you run a business,
then you don't own the depreciation as much.
Exactly. If you run a business with that is flush with cash flow, then I may say there's no benefit to financing the car. Just lease it, because there's a cash flow to cover the lease. You don't have to worry about the extra expenses. But from a regular mom and pop who are 9 to 5 T4, I would prefer buying over leasing, because at least at the end of the day, you own the car. You can turn around and sell it. With a lease, when your term's over,
and lease fees, mileage restrictions.
At the end of the lease, you either have to find another car to lease, or you have to return the car and you're back to square one. You don't have a car. So my opinion is if you must have a car payment, do your best to finance the car. If you can put some down, get the shorter payments and be done with it. Leasing cars, I'm not a big fan of it, unless maybe you run a business and you can, your business can cover the lease payments. That's my 2 cents.
Just a simple piece of advice. A lot of people don't know that car shares exist. My wife really wanted to buy a car. We were very fortunate that she didn't listen to me when we did end up finding this amazing deal on these older people that serviced it at the dealership, that had 3 Subaru Foresters, that gave us an amazing deal on it, that nobody else had happened to look at the car. We got a great deal. But for the first 2 years of our marriage, and it's easier when you don't have a kid and having to use the car seat, but especially if you're single, stack the cash, don't try to be cool like your friends, and sign up for the car share. It's usually about a $500 deposit. You'll get that back when you kind of cancel the membership. It's a very reasonable cost. It includes gas, insurance.
What do you mean car share? Because what do you mean car share? What does that mean?
Car share, there's vehicles parked there's several companies. Typically, there's at least one company in almost every city. And in Halifax, there was 2 of them. They were cars placed all over the city. I would typically only have to walk 1 block, which maybe sometimes is more annoying in the winter. But if it's that crazy of a winter day outside, then am I really bothering going to be driving around anyways? You walk 1 block, you find it shows you on a mobile app all the different places that they have cars. There's different kinds of vehicles. There's SUVs, there's vans. There's typically a lot of them are just smaller economical cars. And you just pay each time you use the car, and it's not an incredible cost. And again, it includes gas, insurance, and all the things. So once you get it set up, you're only using it when you need it. You're typically I think we were spending on average of about $150 to $200 a month for when we wanted to go to Costco or go do a little trip or all of these things. And that really equated to, between all of the things, the gas, the insurance, the car payment, a lot less than we would be paying in another scenario when we're only really using it when we actually
Occasionally.
needed to.
That makes
Actually having a
sense.
deeper contemplation of just, instead of just kind of frivolously going out for a drive because everyone, on the East Coast loves to aimlessly drive. So I'll leave it at that. Be more responsible. Don't go out and get a fancy vehicle for your vanity so you look cool in front of your friends. We're going to close this episode off. I'd love to hear all your comments. And Sean, thank you so much for another episode of Finance Village. 92% of people trust referrals from people they know. But there's a better way to make those introductions. Wrap your arms around your client with your professional team. Join your client's team free today. PocketFinance.com.